Hello everyone, in today's video I want to cover covered call ETFs. Now you're probably wondering, like, what is that? Well, I'm going to cover it today, like talk to you about what is this strategy which is literally called ETFs that have high yield. And you're probably wondering, whoa, high yield? You're like, whoa, tell me about it. So I'm going to talk to you about what is it all about. I also want to talk to you about who's it for and who's it not for, because this is not for everyone. And of course, for sure, stress on the dangers of chasing these high yield ETFs. So if you are looking to invest in covered call ETFs, or you're just wondering what is this whole thing all about high yield. So if you hear of these ticker symbols like ZWB, ZEB, qyld, they are like weird, okay? These ticker symbols are weird. So I'm going to definitely cover those types of ETFs today. Hey everyone, have you been watching my channel and not subscribed? Like, why not? I talk about stocks, real estate investing so that you can grow your income, build your wealth, and ultimately design your ideal life. So be sure to hit the subscribe button and that bell notification button to get the latest and greatest videos coming to you. Plus, it's free. Okay, let's get back with the video. So what is a covered call strategy? Okay, so just gonna give you a simple 101 on options, this options market. The options market is literally where everything's called a contract, and basically they bundle 100 shares of a stock and call it a contract. And when you sell contract and you're selling a call contract, you're obligated to sell your stocks at a certain price called a strike price in the future. And because you're willing to sell your shares in the future when it hits a certain price, someone is going to pay you some money to sit on these stocks. And if it hits a future price, that's the only time you get to sell these shares. So this is the strategy that fund managers use with their ETFs, they're actively managed. And what they do is they bundle 100 shares of, say, Alphabet in this ETF, and they're saying, hey, if it hits this certain price, say 60 days from today, like if Google hits, $2,700 2 months from now, I'm okay to sell 100 shares of Google. And because they're willing to sell these shares and someone else is willing to buy them, the buyer is going to give you some money so that you can sell these shares in the future. Now, what's good about it is that basically these fund managers get to collect income while they own these basket of shares. So essentially, it levels up their stock portfolio. So that's why these ETFs have a higher yield. I mean, we're talking about these ticker symbols like ZWB, qyld, or something like, I think it's qyld, and they have a yield, not dividend, a yield ranging from 6% yield to 9% to 11% yield, as you can see. So this is something that a lot of income investors love. So let's give you a super easy peasy example. I went with Google. If I owned 100 shares of Google and I bought it at like long time ago, and I'm like, hey, I want some income from these Google stocks because Google is not a dividend stock. It doesn't pay me income. And as an income investor, you're looking to gain some income so that you can pay your bills like every single month. So what you could do is sell your Google shares in the options market, where you would sell a call and you would say, hey, I'm willing to let go of Google if it hits $2,700. And someone else, the buyer of that contract, is saying, hey, I'm willing to pay you a little bit of money so that you can sell your shares 2 months from now. Okay, so if it hits $2,700, I'm willing to let go of my Google shares. And if by doing this, I'm also going to collect some income while I sit on these stocks. So this is a great market for those who own shares and really wants to level up their stock portfolio and get some income. But did you notice there was a problem with selling covered calls with the exact strategy I was just talking about Google? This is where it gets a little bit tricky if you're going with these high yield ETFs, because I just said hey, I'm willing to sell Google at $2,700 and I'll collect a little bit of income to, waiting for, if Google hits that price, cool with selling it. So the problem with that thinking is that if you definitely own Google and you're going to sell it in 2 months, first of all, Google could go way higher than $2,700. 2 months from now, it could be like $3,000, like in 2 years. And you're basically letting go of your shares in the very short term just for a little bit of money. So you're really, really leaving a lot of money on the table. And that's where covered call ETFs can really kind of suck, because you're letting go of a ton of upside with stocks. So what are the pros and cons with covered call ETFs? So the pros is that obviously covered call ETFs have great yield. They are over 6% plus. They pay you monthly incomes. Most of the time. They also are great if you're looking to retire early or you're into retirement, then you collect a little bit of income. Another great thing is that they work for all accounts. You can buy it in your TFSA, you can buy it in your RRSP, you can buy it in your cash accounts, which are non-registered. And the most important thing about what's great about a covered call ETF is that it will do well when the market's not really doing anything. Like if the market's just trading sideways, where basically it's going nowhere, you don't know if it's going up or it's going down, or if the market is doing really bad, like in a bear market where the volatility has spiked up, well, I would tell you these covered call ETFs are going to do exceptionally well, because the covered call premiums, which is the income that the fund managers collect by using the covered call strategy, will be very, very, very good, because the pricing of the options contract is partly set by the volatility of the market. So what are the cons with covered call strategy? Well, the one thing is that it definitely underperforms in the bull market. Okay, just imagine if your stocks, you have really good stocks and you sell it every 2 months and just collect a little bit of income. Well, you're selling really good stocks and you're totally giving up all the upside with really, really high quality stocks. Okay, so it really underperforms. These covered call ETFs really, really underperform in a bull market. So in reality, the total returns in the covered call ETF is going to kind of suck compared to an equivalent ETF. Or actually, if you pick a stock, like a high quality conviction stock, like say TD Bank versus ZWB, which is the covered call for bank stocks in Canada, of the top banks, like the top 6 banks are the top positions in ZWB, and compared to TD Bank, I will tell you, TD Bank will definitely blow it out of the water. And another con is that these covered call ETFs most of the time pay their income, like monthly distributions, but they don't always. Okay, it's not guaranteed. Sometimes they don't pay out. Now, who's it for? Okay, if you are in your retirement and you're looking to preserve your wealth, not really to grow your wealth, you're just trying to collect a bit of income because you're retired, you're not looking to blow it out of the water with the greatest returns on investment, well, then these covered call ETFs might be interesting for you. You're looking also for just predictable side income. Okay, sometimes it pays it, most times it pays it, then you love it. You're like, yeah, give it to me all the time. Give it to me, give it to me. Another thing is hey, you've been in the markets for super long and you know how crazy the markets could be. And yeah, there's going to be some bear markets. Okay, the market can be super irrational, pessimistic, money market. Okay, so then you're like, hey, I don't want any of that. Then these covered call ETFs might be for you, because these ETFs actually thrive. The covered call ETF really, really thrives in a very, very volatile market. And it will protect you from the downside. And another great thing about these covered call ETFs, well, you literally don't have to do anything. You just go buy the covered call ETF and then it pays money to you. Okay, you literally don't have to do any or really very little research. You just keep buying them, they keep collecting the income. But let's talk about the reality of it, because I've talked a lot about upside, but let's talk about the downside. So let's talk about who's it not for. So if you are in the wealth accumulation stage, like you are looking to grow your portfolio, really maximize your return on investment, then I don't think the covered call ETF is for you, okay? It's great that has a great high yield, but I'm going to give you some examples and show you in reality what it means when I'm saying it's not great if you are in the wealth accumulation stage. It's also not for if you are like me, where you love owning a company. You absolutely like having a ton of conviction in a company because you've done your research. You like doing fundamental analysis, and it doesn't take that long, honestly. And you love having more control. Well, then you probably don't want to buy an ETF. So it really depends on what's your investing style. Another thing is that if you hate paying management fees, well, I could tell you, because these are actively traded ETFs. They do charge a little bit of premium, which is like less than 1% management fee. Okay, so most times I've seen 6.6%, 0.7% management fee. So every year you have to pay that management fee. And this is the most important one. If you like having control over what you do with your money and knowing absolutely what you are investing in and what company you're investing in, and knowing that you can invest more in that one particular company, I can tell you the ETFs are not for you, because that's my investing style. And if you're like me, who's like a bit of a control freak, I would say not control freak, I wouldn't call you a control freak. I would say that you just like having more control over your money. You like knowing what companies you're investing in. You like knowing where your money's going. Then I would say these covered call ETFs are not for you. Let's go over examples, because this is going to really be real to you. Okay, and we use two examples, which is qyld and the other one is zwb. Okay, I know these acronyms are like gobbledygook, but okay, basically qyld tracks the top 100 companies in the NASDAQ, and then the zwb tracks the top bank stocks, dividend bank stocks in Canada. Okay, so with these two ETFs, I'm going to compare to say if you had invested in an individual high conviction company in that particular market, and what would be the return on investment. And I can tell you, this is where there is dangers, okay? Dangers with chasing yield. So let's look at QYLD's performance over the past 5 years. And I purposely picked qyld because it's actually been performing really well in the past 5 years. If you look at the total returns, including the distribution, the yield that returns back to you, you can see it's like around 73.8%, which is like, yeah, pretty good, right? Yeah, I totally get it. It looks. So if you look at the top 10 holdings at QYLD, you'll notice that there's Apple, Microsoft, Amazon, Tesla, Alphabet, Facebook, Nvidia, PayPal, so on and so forth. I would say if you happen to just say own Apple, which is a super popular tech stock, well, let's look at the performance of Apple stock in the past 5 years. Okay, as you can see, Apple has actually returned a total of 516% in the past 5 years. Apple. Okay, now let's look at Microsoft. Okay, just say, you know, you're like, oh yeah, how am I supposed to just pick Apple? I'm pretty sure you probably would have heard Microsoft. Okay, Microsoft has returned 471% in the past 5 years, which is like, holy smokes. Okay, I could do that with Nvidia, I could do that with Amazon. All I'm trying to get at is that these top 10 holdings actually have like skyrocketed and done super well. Then it measly 73% that ETF is returning to you, including all that yield. This is where the danger of chasing these yield, okay, the ETF yield. I know it's great. It's great for income investors who are like, hey, I don't really care what the stock price is doing. All I care about is collecting income. Fine. But just know that you are totally letting go of a ton of upside, okay? A ton of upside, which is the dangers of chasing these high yield ETFs. So when you look at the the charts for ZWB is flat, okay? It really hasn't gone anywhere since 2012, and maybe a little tiny bit upside, but in the last few years, it hasn't been doing much. And actually, I would say a covered call ETF is great for a basket of stocks that actually aren't going anywhere. If those individual stocks actually have grown exceptionally well in the past 5 years, well, that ETF is going to definitely underperform with a covered call strategy, because you're literally selling stocks every couple months so that you could collect a bit of income, which is why it has a high yield. Okay, but let's talk about the total performance of ZWB. So when you look at the total performance of ZWB, you're looking at, hey, it's pretty decent. It's 57.5%, which is like, hey, that's actually pretty good, including all the yield. But let's look at say if you picked one of the bank stocks in the last 5 years, because I think like that's where I really want to compare it to. Like if you picked, say, one of the top bank stocks in Canada, let's look at TD Bank. What's been the performance of TD Bank in the past 5 years? Okay, if you look at the past 5 years, well, I would say TD Bank has looked pretty amazing. Okay, that is a beautiful chart for TD Bank, and that's since inception, since 1992. Now let's look at the total performance in the past 5 years. The total performance has been 83.8%, okay, including dividend returns. So not only did TD Bank do well because it's a great dividend stock, but it also performed really well as a stock with a pretty good appreciation for something that's just a bank stock. You could do the same thing with Royal Bank. Look at Royal Bank. Royal Bank had a total performance 82.2%. So you could tell, like if you own any one of the leaders of that ETF, it would have like totally done better than the actual covered call ETF, because again, you're giving up a ton of upside. So hey everyone, proceed with caution when you see these covered call ETFs that have these amazing yields of 6++, 11++%. Now it's great, of course it's great if you are an income investor, but just know that if you're investing in these covered call ETFs, you are likely, well, I know you are, you're going to be giving up a ton of upside when it's in a bull market. And we are in a bull market today. So when you're in a bull market, investing in a covered call ETF, just know that you are giving up a ton of upside. And the only time these covered call ETFs are actually good is when the market's like, and there's a lot of volatility. So these covered call ETFs really protect you from the downside, but you're only looking to preserve your wealth, and you're okay giving up some upside because you're good with just collecting a little bit of income. Honestly, for me, if you are like me and you're looking to maximize your return, you're really trying to grow your income plus your wealth and gain maximum return on investment, and you're super bullish about the stock market, I would say just don't look at covered call ETFs. I just wanted to share it with you just so that you know, and you do it with eyes wide open if you ever happen to come across someone talking about these weird ticker symbols, okay? Anyways, I hope you found this video super helpful. If so, smash that like button, smash it, so that you let me know first that you like my video, and secondly, so that I can make more of these videos for you. I'll see you in the next video. Thank you.